Over the past couple of years, one of the central themes of the Reserve Bank's communication has been that the Australian economy is in a period of transition. A transition from the biggest resources boom in over a century to something that's just a little bit more normal. Now, the sheer scale of this resources boom has meant that this transition has its challenges, and that these challenges are being compounded by events beyond our shores. A second theme of our communication has been that a reasonably successful transition is possible, and indeed it is probable. And my own view is that this reflects the underlying positive fundamentals of our economy and its underlying flexibility. This flexibility was important in helping us deal with the upswing of the resources boom, and it's now helping us deal with the downside of that. And a third theme of our communication has been that monetary policy is helping in the adjustment, but the likelihood of a successful transition would be boosted by a lift in underlying productivity growth and an increase in the expected risk-adjusted return on capital formation, and that's both physical capital and human capital. So today I'd like to take the opportunity to again touch on each of these three themes. I want to start with developments in the global economy, particularly in China, as they form a very important backdrop to what's going on here. And then I'd like to use the second half of the talk to talk a little about the ongoing adjustment in our own economy. It probably doesn't come as any surprise to you to say that the main news over the past month or so is really out of China. Two developments in particular have caught people's attention. The first was the large decline in the Chinese equity market, and the second was the decision by the Chinese authorities to allow the RMB to depreciate against the US dollar. As you can see here in this first chart, the Chinese equity market, or in the Chinese equity market, prices have fallen by around 40% since mid-June. And this fall has reversed around 2/3 of the increase that occurred over the previous year. Now, the reasons for the earlier increase are not entirely clear. One possible factor was that the Chinese authorities reduced some or removed some of the restrictions on margin financing. Another possibility was the expectation of Chinese citizens of future capital gains as the equity market opened up to offshore investors. And a third possibility was the weakness in the property market in China. Whatever the reasons for it, things went too far, as they often do. Many investors thought that the increase in equity prices would keep going, and many were prepared to borrow to get into what they saw as a rising market. A bubble developed here, and then it burst. While this has attracted much attention around the world, I think it's fair to say that these movements in the Chinese equity market aren't likely to have material direct effects on the Chinese economy. In terms of the exchange rate, for much of the past few years, the RMB has moved closely with the US dollar, and you can see that in that light blue line there. This meant that as the US dollar appreciated over the last year or so, so too did the Chinese currency. So on a trade-weighted index basis, the RMB was up around 15% between mid-2014 and July this year. So that's a substantial increase. With the US and the Chinese economies being in clearly different parts of the business cycle, it's perhaps unsurprising that the Chinese authorities might have come to the conclusion that greater flexibility of the RMB against the US dollar was warranted. Notably, a move in this direction is consistent with the authorities' long-standing goal of transitioning to a more market-determined exchange rate. And while this change in the Chinese exchange rate has also attracted a lot of attention, I think we do need to keep in mind the magnitude of the change. At around 3%, the recent depreciation is hardly out of line with the short-term movements that we often see amongst the major freely floating currencies of the world. These developments in the Chinese financial markets have coincided with signs of some further slowing in the Chinese economy. And you can see that in this chart here. There's been a slowing in growth of industrial production, retail sales and fixed asset investment. And the same general pattern is evident in Chinese exports and in the various Chinese business surveys. One area that's looked a little better in recent times is the residential property market. You can see that in the bottom right here. While the aggregate level prices are still lower than they were a year ago across the country, in the larger cities in particular, prices have stopped falling and have actually risen a bit recently. If you put these various pieces of news together, they've had significant ripple effects on global equity markets over the past few months. Volatility's picked up, and many of the major equity markets, including Australia's market, are down by 10% or more from levels a few months ago. The volatility is also transmitted to the commodity markets, and most commodity prices are lower than they were a few months ago. I think it's noteworthy, though, and it's important to note that there's increased volatility in both the commodity markets and the equity markets has not led to dislocation in financial markets more broadly. There has not been any deterioration in funding markets, and credit spreads have mostly moved in a fairly narrow range over the past month or so. So that's something that I think is encouraging. These recent developments in China have understandably shone the spotlight on the outlook for the Chinese economy. And at the moment, assessing this outlook is complicated by the fact that China is simultaneously adjusting to slower growth in its potential output and dealing with a relatively soft part of its own business cycle. The slowing in potential output growth in China after a truly extraordinary period of sustained double-digit growth was inevitable, and indeed it was widely expected. It has, however, brought into quite sharp focus some of the structural challenges facing the Chinese economy. These challenges include the challenge of shifting from investment-led to consumption-led growth, the challenge of liberalising important factors of production, or the markets for important factors of production, including labour, land, capital and energy. The challenges brought about by demographic change, with the Chinese working age population now declining and the overall population ageing quite quickly. And the challenge of dealing with various strains and distortions in the financial system and in the Chinese property market. At various times over the past few years, the Chinese authorities have indeed acknowledged each of these challenges, and a range of plans have been developed to deal with each of them. However, it's yet to be seen how successful these various plans will ultimately be. There's no doubt that the Chinese authorities have, over the past couple of decades, had a remarkable success in lifting hundreds of millions of people out of poverty. The challenges, though, they face are not getting any easier, and the authorities' recent handling of the stock market crash has led some to ponder the general direction of Chinese policy, including the likely pace of reform across the economy, and this is an issue that I think we'll all be watching very closely over the months ahead. From a cyclical perspective, the authorities have recently taken a number of steps to support growth. An important one of these is some increased spending on infrastructure. Another is a reduction in nominal benchmark interest rates, which you can see here. Although with inflation having declined in China over the past year, real interest rates have actually risen a bit. As you can see on the right-hand panel there, reserve requirements in the banking system have also been lowered, although this looks designed to offset the withdrawal of liquidity that's taken place as the Chinese authorities have sold foreign exchange reserves in response to private capital outflows out of China. And the depreciation of the RMB against the US dollar, which I spoke about a minute ago, could also be expected to provide some support at the margin to the Chinese economy. So overall, it's a complicated picture in Australia's largest single trading partner. We did become used to extraordinarily strong growth in China, and we're now having to get used to something a little less extraordinary. And we're also being reminded that China, like other countries, has a business cycle. It does, though, remain the case that there are very significant mutually beneficial opportunities from deeper relations between Australia and China. As a nation, we need to keep an eye on these opportunities, but at the same time, we need to understand and manage the risks associated with those opportunities. If we look beyond China, elsewhere around the world, the recent economic data have mostly had a slightly more positive tone. The US economy is recording above average growth, and the unemployment rate there is close to most estimates of full employment. In Europe, the economic news has tended to be a bit better than it was earlier in the year, and a recovery of sorts is underway there. In India too, the growth momentum looks to have improved, although working in the other direction in a number of countries in East Asia, both domestic demand and export growth looks to have slowed a bit. On the whole, for the globe as a whole, economic conditions continue to be supported by a decline in oil prices. In addition, the drag from fiscal consolidation has lessened in quite a number of countries, and monetary conditions remain very accommodative around the world. At some point before too long, I think we should hope that the US economy is sufficiently strong for the Federal Reserve to begin the process of normalising interest rates there. A stronger US economy is clearly good for the world. The financial market developments, however, will need to be watched very carefully, given that policy interest rates in the US have been at zero for almost 7 years now, and the last increase in interest rates in the United States was 9 years ago. If we put all this together, when the RBA published its latest forecast a bit over a month ago, we were expecting GDP in our trading partners to grow at around an average pace for the next couple of years, and you can see that in the red bars here. While recent news on global industrial production has tended to be a bit on the softer side, on balance, the recent data have not changed the general outlook materially. We still expect GDP growth in our major trading partners to average around 4% this year and next, although given the recent developments in East Asia, the risks are probably tilted a little to the downside around this central forecast. So that's the global economy. I now want to turn to the adjustment in our own economy. And I think the broad story is very well known here. Over the past decade, Australia has experienced an extremely large external shock in the form of a resources boom. And this boom has had three phases, and you can see them here. In the first phase, there was a very large increase in commodity prices. In the second phase, there was a very large increase in investment in the resources sector. And in the third phase, there's a very large increase in resource sector production and in exports. While these various phases have overlapped at times, we are now very much in this third phase, with higher production generating higher exports, but commodity prices considerably lower than they were a few years ago, and resource sector investment returning to more normal levels. During the first two phases, there was a significant reallocation of resources within our economy. And this was important in helping the economy not overheat in what was an extremely large external shock. But the adjustment back the other way is now taking place, and it's been taking place for some time. Indeed, the terms of trade have been declining for almost 4 years now, after having reached a peak in the second half of 2011. Over this period, the global supply of commodities has increased very substantially as the new investment projects, many of which are in Australia, have come on stream. As a result of this, the prices of our exports relative to our imports have fallen by around 30%. And this decline in the terms of trade brings the terms of trade back to their level in the mid-2000s, Well, it is important to remember that they, at that level, they're still considerably higher than they were on average in the 1990s and in the previous decade. As you can see, the peak in mining investment occurred around a year after the peak in the terms of trade. In mid-2012, mining investment reached a record peak of around $30 billion per quarter. It's an extraordinary number. Since that time, mining investment has fallen significantly. It's currently around $20 billion per quarter. Further declines still lie ahead as current projects are completed. Although the end of the large declines now looks to be coming into sight, our current forecast is that mining investment will decline to around $10 billion per quarter by the end of 2017. And if this does turn out to be correct, then we're currently halfway through the decline in mining investment. In contrast, the ramp up in resource sector output is still underway, as you can see on the bottom panel there. Over the past 3 years, resource exports are up 20%, and annual increases of 9% are expected over the next couple of years as LNG production increases. While there's inevitably some degree of imprecision in any estimates, the increase in LNG exports is expected to boost GDP growth by an average of around 3/4 of a percentage point in each of 2016 and 2017. That's a significant contribution. Now, right through this third phase of the mining boom, the economy has been, on average, growing between 2 and 2.5%, as you can see here. At the quarterly level, the readings for GDP continue to be affected by fluctuations in mining production due to the weather. But if you look through the quarterly volatility, the data for the most recent quarter suggests the economy is continuing to grow at a rate similar to that of the past few years. Most other recent indicators are also consistent with a moderate expansion in our economy, and you can see this in this chart. Measures of business conditions have improved, and most of them are now above average. The unemployment rate has been little changed for over a year, and the demand for labour has increased, so there's been a rise in the employment relative to the working age population. The housing cycle remains in a strong upswing, and household consumption is growing moderately. For many people in the community, though, the fact that growth is occurring at only a moderate pace is disappointing. Growth has been slower than we'd become used to, and slower than I think we're capable of. In terms of our incomes, this is being compounded by the decline in the prices of our key exports. As a result of these developments, there's been very little growth in our real income per capita for quite a few years now, after we'd had a decade and a half of extraordinarily strong growth in real income per capita. Now, while this disappointment is understandable, we should not allow it to cause us to lose sight of the fact that the economy has shown a considerable ability to adjust, and to do so in a way that preserves both overall economic and financial stability. We've adjusted to the upside of a huge positive international demand shock without the economy overheating and imbalances developing. And we're now adjusting to the downside while still managing to grow at a moderate rate. I think this is a significant achievement, and it is testimony to the underlying flexibility of our economy. And this flexibility should give us some confidence that we can manage the future. An important element of this flexibility is the exchange rate. When the terms of trade initially started to fall and the decline in mining investment was clearly in sight, the exchange rate was relatively slow to adjust. And on quite a number of occasions, the Reserve Bank drew attention to this. But the exchange rate has now adjusted considerably, and this adjustment has continued over recent weeks. So just as the appreciation helped stabilise the economy in the upswing of the boom in commodity prices and mining investment, the depreciation is helping us manage the downswing. One example of this is in the tourism industry. As the relative cost of overseas travel has increased with the lower Australian dollar, more Australians are holidaying domestically and more people are visiting our shores. Encouragingly, we're now seeing some signs that this change in travel patterns is promoting a pickup in investment in tourism infrastructure. In particular, there's been a noticeable increase in the stock of work to be done in the construction of hotel and related accommodation. You can see this in this chart. The bank's liaison with tourism-related businesses suggests that further increases in investment in this area are likely over coming years, and conditions have also improved in a number of other sectors that are sensitive to the exchange rate. Another element of the flexibility has been the labour market, both in terms of labour supply and wages. During the upswing, population growth picked up noticeably, partly due to a rise in immigration, and this helped alleviate some of the pressures in the labour market that would otherwise have occurred, especially in areas where skills are in short supply. In the downward phase now, population growth has slowed, partly again due to immigration, and aggregate wage growth, as you can see here, has moderated very significantly. This moderation in wage growth has played a role in generating sufficient employment growth to keep the unemployment rate steady, despite below average growth in the overall economy. And the third element of this flexibility has been monetary policy. As the Reserve Bank has frequently noted, it's entirely appropriate that during a period in which both the terms of trade and mining investment are declining, that monetary policy is accommodative. This current stance of policy is helping support growth in the overall economy, even if it's not working quite the same way as it used to. This support is most clearly evident in the interest-sensitive housing construction sector. Investment in housing construction is up 7% over the past year. And the stronger housing market is also having some positive ripple effects on parts of the retail sector. So together, the flexibility of the exchange rate, the labour market and monetary policy is helping with the cyclical adjustment in our economy. The missing ingredient continues to be a lift in non-mining business investment, and we're still waiting for convincing signs of a pickup there. The latest reading from the ABS on firms' capital spending plans outside the resources sector did show a slight improvement from earlier readings, but a material lift in non-mining business investment still seems to be some way off. In time, though, I think we should expect that the adjustments that we've seen in these cyclical variables, the exchange rate, the labour market and interest rates, will help create the environment that does lead to increased business investment. There are clearly limits, though, here. A low exchange rate, low growth in wages and low interest rates are not the basis for sustained increases in investment and output. They can certainly help during the adjustment phase, but ultimately we will be better off if increased investment is driven by high expected returns rather than the low cost of finance or low wages. And I think this is why the focus on improving the climate of business investment is so important. There's no magic bullet here, but surely the investment climate would be improved through a strong focus by both business and government on innovation, on productivity, on human capital and entrepreneurship. These are all topics that I've spoken about on previous occasions. I think on that note, Stephen, I will hand the microphone back to you and thank you everybody for listening, and I'd be happy to answer questions.